So welcome back to Talk Tickers. Our mission today for this deep dive is, well, we're getting right into the corporate earnings world, but without all the, confusing corporate speak.
Right, exactly. We want to translate this.
Yeah, translate the STERIS plc, ticker STE, their Q4 2026 earnings transcript into something fast, data forward, and actually actionable for you, the retail investor.
Because there's a lot hiding in the numbers this time around.
There really is. I mean, STERIS is this absolute giant in medical equipment and sterilization.
Right, massive, yeah.
And on the surface, things look fine, but we need to set the framework for this rapid fire analysis.
Yeah, so today we're really looking for the truth that's kind of hidden in their margins. Mm-hmm. We want to look at the headwinds the company is facing right now and ultimately whether their capital allocation signals a buy or a bail for your portfolio.
Right, the buy or bail decision. So let's just hit the headline numbers first.
Let's do it.
The big picture for fiscal year 26. I mean, total revenue for the year topped out at approximately $6 billion.
Which is a huge milestone.
Yeah, it's about a 9% as reported growth or like 7% on an organic basis.
Right.
And full year adjusted EPS, earnings per share, was a really solid $10.17, up 10%.
Yeah, the full year looks great on paper, but, and I hate to be the voice of reason here, we really need to look at the Q4 squeeze.
The reality check.
Exactly. The specific Q4 reality check is a bit different. So Q4 EPS was $2.83,
right,
which is only a 3% increase over the prior year. But Q4, as reported revenue, grew 7%.
Wait, okay, let's unpack this for a second.
Yep.
Because for the retail investor listening, this is the critical question.
Right.
If revenue is growing at, 7%, why on earth did earnings per share only limp up 3% in the fourth quarter?
Right, and that's the exact friction point. You have to look at the specific margin data to see why.
Okay, lay it on me.
So gross margin for the quarter was 44%. But the EBIT margin, earnings before interest and taxes, that was 24.2%.
Which, that sounds okay. Right?
Well, management highlighted it as a high for the fiscal year, sure.
Yeah.
But year over year, it was actually 60 basis points below Q4 of last year.
Oh, wow. Okay, down 60 basis points.
Yeah, they actually lost ground on profitability compared to the same time last year.
So, that leads us perfectly into part 2 here. What is actually eating into the profits? What's the story behind these numbers?
It's essentially an inflation and tariff tax. That's the biggest culprit for that 60 basis point drop.
Tariffs, really?
Yeah. Tariffs cost STERIS $46 million for the year.
Wow.
Which, is an 80 basis point trim on their overall margins. And it got worse as the year went on. There was a 10% incremental impact in Q4 alone.
Just for the tariffs?
Just for the tariffs.
Why not?
And on top of that, their adjusted effective tax rate jumped up too.
Right, I saw that. It went up to, 25.4%?
Exactly, up from 23.5% last year.
That's a huge jump for a tax rate. Why?
It's a mix of where their profits are geographically and these withholding taxes that get triggered when they move cash across borders.
Okay, so they're making money overseas, but to bring it back to the U.S. to use it, they're getting slammed with holding taxes.
Exactly. It's a double whammy. Tariffs hit the operating margin and taxes hit the net margin.
But, there is a silver lining here, right? Because STERIS really flexed its pricing power to fight back against this.
They absolutely did. They realized 230 basis points of positive pricing.
So they just raised prices by 2.3% to offset the inflation and the tariffs.
Yep. Because hospital infrastructure is so sticky, you can't just stop sterilizing your surgical tools because your vendor raised prices.
Right, the switching costs are way too high.
Exactly. But to really understand this, we need a segment breakdown because we have some good news and some bad news.
Hit me with the good news first.
The good news is the healthcare segment. It grew 9%, and that was driven by this incredible 12% growth in service.
12% just in servicing the equipment.
Yeah, it's that recurring revenue model. Once the machine is installed, you have to keep paying them to maintain it. It's super high margin.
Okay, so that's the good. What's the bad?
The bad is the Applied Sterilization Technology segment, or AST for short.
Right. This is where they do the contract sterilization for other medtech companies.
Exactly. Now, to be fair, AST crossed a massive milestone, over $500 million in operating profit for the year.
That's huge.
It is. But Q4 volume took a real hit. It had a very sluggish finish to the year.
Okay, why? What caused AST to slow down so much in Q4?
Well, there are two real-world reasons. First, just acute logistical stuff. There were freak snowstorms in the U.S. that literally halted production and trucking.
Oh, right. So physical pallets of stuff just couldn't get to their sterilization facilities.
Exactly. But the second reason is more structural. MedTech customers are carefully, quote, managing inventory right now.
Managing inventory. What does that actually mean in plain English?
Think of it like a real-world analogy. It's like during a crisis, say a hurricane is coming, you overstock your pantry with canned goods, right?
Yeah, you hoard everything.
Right. Well, during the pandemic supply chain crisis, MedTech companies hoarded inventory. They overstocked their pantries.
Oh, I see.
And right now, those supply chains have normalized. So those MedTech companies are just eating through their pantry before they go out and buy more groceries.
So they aren't manufacturing new stock, which means they don't need STERIS to sterilize it. They're just selling off what they already have sitting in the warehouse.
You nailed it. It's a totally temporary cycle of inventory digestion.
Okay, so that makes a lot of sense, which I guess means we should pivot to the future. What does management say about all of this in their guidance? What does this mean for FY27?
Management's projections are actually surprisingly strong, considering the Q4 weirdness.
What are we looking at?
They expect 7 to 8% reported revenue growth for FY27, and EPS is expected to hit between $11.10 and $11.30.
Okay, so that's like a 9 to 11% growth rate on earnings. That's solid.
Right. And they expect EBIT margins to expand by about 50 basis points.
Wait, up 50 basis points. How are they expanding margins if tariffs are still a problem?
Well, they're modeling for flat tariff spending, so it shouldn't get worse. But honestly, the biggest help is a $20 million bonus tailwind.
A bonus tailwind? What, they're just paying less in bonuses?
Basically, yeah. Last year, they overperformed internal targets and had to pay out huge bonuses. This year, they're modeling for normal payouts, so on an accounting basis, it looks like a $20 million savings.
Okay, so that's a bit of an accounting trick, not really pure operational improvement.
It's just the mechanics of accrual accounting, yeah. But they are making real operational moves with their capital.
Yeah, let's highlight how they're actually spending their cash. I saw they're integrating 2 tuck-in acquisitions, right?
Yep, MedGlass walls and some GI products.
And those are expected to add like $45 million in combined revenue.
Exactly. Just smart, low-risk additions to what they already do. No crazy leveraged buyouts.
And they're also building a new plant, right?
Yeah.
I saw they're spending $60 million over 2 years on a new facility in Mentor, Ohio.
Yes, a highly automated sterility assurance plant. They are consolidating their U.S. production.
Which makes sense. Bring it stateside, automate it, and skip the whole international supply chain and tariff headache entirely.
Exactly. It's a great long-term move. But if you're a retail investor, the absolute loudest signal for management wasn't the plant or the acquisition.
Oh, the buyback. We have to talk about the buyback.
The board just authorized a massive new $1 billion share buyback program.
$1 billion.
Yes. And they are committing to $200 to $300 million in buybacks per year moving forward.
Okay, but wait. If they are buying back shares in the U.S., they have to use that overseas cash, right? The same cash that triggers those massive withholding taxes we talked about.
That is the crucial point.
Yes.
They are voluntarily paying a tax penalty just to move the money to buy their own stock.
Wow. That's conviction.
It really is. It tells you management thinks the stock is so undervalued that taking a tax hit is still worth it to shrink the share count.
Okay, so looking at all of this, we've got margin pressure, we've got tariffs, we've got $1 billion buyback and solid guidance. Right. What is the bottom line here? Is this a bullish or bearish signal for you, the retail investor?
Honestly, I'm decisively bullish on STERIS.
Really? Even with the Q4 AST volume drop?
Yeah. The short-term margin pressures from tariffs and weather, those are transient. But look at the cash. They generated an exceptional $982.9 million in free cash flow this year.
Nearly $1 billion in free cash flow. That is undeniably strong.
Right. They increased their dividend for the 20th consecutive year, and they're actively fixing their supply chain issues by consolidating stateside manufacturing.
So the fundamentals are totally intact.
Completely. For the retail investor, the underlying fundamentals of the healthcare sector haven't changed at all. U.S. surgical procedure volumes are growing mid-single digits.
Yeah, an aging population means more surgeries no matter what the economy is doing.
Exactly. It provides a highly reliable floor for long-term growth.
Okay, so to wrap this up, I want to leave the listener with a final kind of provocative thought to chew on.
Oh, I like these. Let's hear it.
So we know medtech companies are currently draining their inventories.
Yeah.
Rather than buying new stock, right? They're eating through the pantry.
Right, the inventory digestion phase.
But hospital procedures are steadily increasing at the same time. People are still getting hip replacements and pacemakers. So what happens when those medtech companies completely run out of their safety stock inventory and they have to aggressively restock all at once?
Oh, the bullwhip effect.
Exactly. Will STERIS experience this unprecedented whiplash of explosive demand in the coming quarters when all these medtech companies suddenly rush to sterilize a mountain of new products at the exact same time?
It is entirely possible. When that pantry is empty, the rush to the grocery store is going to be massive.
Definitely something for investors to keep a close eye on.
Absolutely.
All right, well, that's all the time we have for today's deep dive. As always, a reminder that we aren't endorsing any specific market viewpoint or telling you what to buy.
We're just here extracting the intelligence directly from the source material.
Yep, trying to keep you well informed and ahead of the curve. Thanks for listening, and we'll catch you next time on Talk Tickers.